The Little Book About Investing by John C. Bogle, okay? And the first thing I want to say is this, guys. The reason I like reading books so much is because I can basically learn from people that came before me, after me, or are right here in this time with me right now. So that's why when I heard that John C. Bogle actually died last year, January 16th, I got a little sad because I've been basically using his techniques for the past 2 years without even knowing exactly who he was, his history, where he came from, and how everything actually came into fruition. So that's why in this video, my whole entire goal is to kind of teach you guys exactly the 3 main nuggets I found in this book, but most importantly, to try to do justice to his theories and just explain to you guys the basic idea of how everything works and why he believed what he actually believed in this very common book of common sense investing. Now, if you guys don't know me, my name is Sonny Bryson. I'm an accountant and I upload videos on YouTube every single day. And on top of that, if you haven't done it already, go ahead and subscribe to the channel, hit the bell so you get notified, and do me a favor for the algorithm on YouTube and smash the like button. Now, the first question I want to ask you guys is this, okay? I'm going to put a little chart right here showing you guys exactly what your investment should actually be strategy when it comes to stocks versus bonds and the ratio compared to your age. So if you ask me, Tommy, where are you right now? Well, right now, I'm doing 80% stocks and then 20% bonds because, again, I am between 18 to 35 years old. But comment down below and let me know, are you using a strategy right here or are you using something different? And this strategy is in comparison to what I actually found in this book, The Little Book About Investing by John C. Bogle. Again, now, if you ask me, guys, okay, people tell me all the time, Tommy, why not just do, because you're 22 years old, so why not just go basically 100% into stocks because you're so young? The answer is, to me, I'm not a big fan of taking unnecessary risks just because I'm young enough to take the risk. The answer is, I'm not a big fan. So basically right now I do 80-20, 80% stocks, 20% bonds. But comment down below and let me know, what are you currently doing? Comment down below, let me know. And guys, the basic idea for this book is basically, it's a book talking about statistics and all the ideas when it comes to investing in the strategies and which one works best. But it's not a book and be like, okay, this is wrong, this is not right. It's kind of impossible to disprove what he says in this book because basically it comes from facts and statistics. So all he's saying in this book is kind of like been proven already. So there's no really argument here, but just to decide exactly what you want to do and what road you actually want to pick. So for example, the first nuggets I found in this book is basically, how do you actually want to invest and the type of investor you actually want to become. So in this book, he talks about 3 different ones. The first one is if you want to invest individually into your own stocks and pick ones and basically be like a stock picker, okay? The second one is, do you want to invest with a high cost mutual fund that talks about, oh, tax aversion, trading here and there, and also trying to beat the market? Or do you want to invest in a low cost index fund that tries to save you a lot of money over a long period of time? For example, lately this month, it has been the month of Tesla. Everyone has been telling me, Tommy, you need to invest into Tesla. Go ahead and invest into it. I did it and I gained 30% in 1 week. Isn't this great? Isn't this amazing? And it did all this, and literally the next week, they lost a ton of money because there was a bubble in a sense. Now, Tommy, what is this called? It's not called investing. It's basically called guessing and gambling. So if you want to do this correctly, I'm going to compare you to Warren Buffett, okay? If you want to do this correctly, I'm going to compare you to the best person doing this at the highest level. So for example, Warren Buffett takes every single day around 5 to 8 hours to do research on companies to then at the end of the year or throughout the year to invest into 1 or 3 different companies, and that's about it. So basically, it takes a lot of work to select companies by hand because basically it's not just like, hey, I like Tesla, I like Apple, I like Amazon, they're great companies. The answer is, it's not as simple as that. You have to analyze a company and understand exactly how it works to then determine if you can actually invest into it and actually make a profit. Now, the second way to do it is, for example, if you want to actually invest with a mutual fund and they have a manager and they're going to charge you that 1% fee that is so low, but I'll be honest with you guys, in the beginning, I thought that 1% was not a big deal. Probably just like you, right? But I found out that 1% is going to add up to around 33% of my entire portfolio value. Isn't that surprising? Well, here's how it works, guys, okay? If you were to invest into two different funds, okay, and you had $10,000 to actually invest, by the way, the whole pros are, I got a call one day, right? And the guy called me, he was like, Tommy, I want to manage your entire, by the way, it's a big company, okay? It's not like a random guy, but it's a big company. He told me, Tommy, I want to manage your entire retirement fund for your entire company, so why not go ahead and invest with us, okay? What we're gonna do is we give you financial advice whenever you want it. On top of that, we balance your entire portfolio, we trade it here and there, and our goal is to basically try to beat the market for you. And I said, well, what if I just don't want any of that stuff whatsoever, and I don't even want you to talk to me, and all I want to do is just invest my money and hold it there for around 40 years without making a single trade? He told me, Tommy, although that might be a great strategy, we still have to charge the 1% because at the end of the day, we are a business and we're trying to make money. And that 1% adds up to a ton of money. And here's how, guys, okay? Basically, if you had $10,000 and you invested this $10,000 in one company that was charging you a low-cost index fund in this case, that's charging you around 0.09%, and the other company is charging you 1.02%, you might say, well, 0.09% and 1.02% can't really be that different, okay? But if you invested $10,000, okay, and you said, for example, I'm not going to contribute anything else, so I'm just going to leave it there for a very long time, and on top of that, I'm going to leave it there for around 40 years, and I'm expecting to gain around 7% every single year without accounting for inflation. So over this time of 40 years, your money would have grown to around $149,000. That $10,000 would have grown to around $149,000. Probably saying, I mean, that is a lot of money over a long period of time. So basically, what has been the fees expenses compared to that 0.09% and that 1.02%? Well, in reality, the 0.09% only really cost you around $5,000. But that 1.02% actually cost you around $49,000 just because of the fees. Tommy, that's around 33% of my value. The answer is yes, because whenever you're talking about investing and they're turning over your investments, they're trying to trade it back and forth, they're trying to beat the market, but they really don't. In reality, they're charging you that 1% plus a 2.5% inflation fee, plus any taxes, plus any turnover. So all these fees add up to a ton of money over time, and that's why that entire 1.02%, although it might seem very small, is going to cost you almost 33% of all your value, although you were the person taking all the risk. And that's why John was a very good activist of talking about index funds and having a very low cost, because imagine 5K versus 49K is a huge massive difference, okay? And when it comes to, for example, well, Tommy, what about index funds? Well, index funds is the example I just told you. If you invest in an index fund that only charges you around 0.09%, well, over a long period of time, this adds up to a very minimal low fee. And the entire goal here for investing is you want to minimize the cost of investing, and that way you get to keep a lot more of the money you actually make for yourself in profit. And that's what John did in this book. He actually talked about it, how he did the entire thing. Because again, guys, John is the founder of Vanguard, a $5.3 trillion company. So believe it or not, this guy knows what he's talking about. And that's why today what I do is I invest into index funds and also ETFs by using Acorns. Now with Acorn, basically last year of 2019, I actually managed to gain around a 9.42% gain plus a 2.35% gain on my entire dividends. So in reality, my total gain was around a little bit over 11%. But once I adjust for inflation, because again, Acorns does not charge me any management fee of 1%, only $1 a month, okay? So once I adjust for inflation, I am still at a 9.27% gain in a year, which is not average, okay? Because right now the market is going up, 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 and it will come down at some point. But the point is, by investing into an entire portfolio made out of ETFs and bonds, this makes me have a lot more balance, a lot more diversification, and that way I am good to go. But there is no way that I'm going to take my money and invest it into quote unquote a mutual fund trying to beat the market and then pay them 1%. By the way, surprise here, okay guys, only around 2% of them actually manage to actually beat the market within a 30-year period. You might say, Tommy, that is pretty hard. The answer is yes, it's so hard that even though they might try to beat the market at the end after 30 years, in reality, you still manage to do a lot better than them at the end of that time. By the way, 2% is like trying to find a needle in the haystack, trying to find that person, that manager that's actually going to help you accomplish that goal. In reality, it's way better to just invest into index fund and try to track the market versus trying to beat the market, because again, that is almost impossible. And now the second nugget that I found in this book when it comes to stock market is basically 3 rules to abide by when you're trying to invest. And although people might think like, hey, when you invest, that's gambling, the answer is no. Gambling is people that invest without knowing what they're actually investing into, okay? That's the whole point here. Now, the first rule that I learned is basically don't talk about Fight Club. Wait. This is the wrong video, okay? Wrong video. I'm sorry about that. But basically, the first rule that I learned is that you cannot predict the market, okay? You can't try to beat the market, because usually over a long period of time, you might do it for 1 to 2 years, 3 years maybe, but after 10 years, 20 years, 30 years, 40 years, 50 years, it's almost impossible. And here's why. Because the market isn't just based on, hey, a company is doing well, it goes up in price, its value goes up, it's selling more products. The answer is no. That's not all to it. It's based on human emotions, and that is impossible to predict. So right now, Tesla went up by 30%. No one knew why. Then it went down by 20% because something about China. It's insane, you know. So that's what happens. You know, emotions of people get in the way, and that's why you can't really predict the market, try to beat it. So that's why it's better just trying to follow it and try to follow that wave, and that way you get the return over time with a proper index fund with a very low fee, and that's the best way to invest if you ask me. And now the second rule that I found, guys, in this book is basically, if it sounds too good, it's probably too good to be true, okay? If it sounds like free lunch, then somebody has to be paying, okay? At some point, somebody has to be paying for that free lunch. For example, every day people tell me all the time, you need to start day trading, okay? It's the best thing ever. You're gonna make millions of dollars. You need to start gambling. It's gonna be the best thing ever. You need to go out there and do Bitcoin. You need to go do out there Forex trading. And I'm like, wow. This is great, okay? This is great information, but in reality, when you do the research, it turns out that 80% of traders lose money. Forex traders, people trying to do Forex trading right now, in reality, they're not making any money either. Only the experts are. So when you ask me about day trading, when you ask me about all these things, people that are trying to do this incorrectly usually are just looking for a lottery ticket, okay? And lottery tickets in investing, they don't exist. You might get lucky once, but to do that twice, 3 times, 4 times, 5 times, it's almost impossible. So that's why I don't participate in the guessing game, into the Forex trading game, into all these games, because although I know for a fact people make money from them, that is only a small percentage of experts, but not the average person. And in this case, I'm the average person. And most likely you're the average person also, but if you want to become an expert, it's going to take time. It's going to take a lot of work, and it's not as easy as, hey, just start trading today with my course and now you made $1 million. The answer is it doesn't work like that. And that's why the third rule I found in this book is that boring average is good when it comes to investing. If you ask me, I don't want my investing life to be a movie. I don't want to say like, hey, I was at, 10,000 last month. This month I'm at 1,000, but let's see what happens next month. Is a great plot for a movie, right? I don't want that. What I want is consistent returns. If you ask me, average, boring is great, and predictable is great when it comes to the market. So I know for a fact that over time, there's 100 years of history to show this, over time the market will average out, thus giving me my proper reserve return on my money by investing in this shape and form that John talks about in his book, okay? And whenever you hear someone trying to complicate investing and not simplify it, usually is a salesman trying to tell you, hey, we're gonna do this, we're gonna sell your entire stocks, we're gonna trade it, we're gonna management, we're gonna help you with your entire tax aversion, not tax aversion, but tax harvesting, we're gonna help you with all this stuff. But in reality, investing is supposed to be simple, and that's just them trying to justify charging you 33% of your entire portfolio, not just that 1% fee. And if you ask me, is it worth it? The answer is no. And now the last nugget, number 3 that I found in this book, guys, is very simple, And it's kind of like you have to pick your cards right, okay? Whether you want to do stop picking and you want to do it correctly, you can make money. Whether you want to do index funds and just like do low cost ones, that's great. Whether you want to give someone 33% of your portfolio value, well, that's up to you also. But in the end, guys, you know, I might be using all these analogies like the casino, picking your cards right, but in the end, the stock market is not a gambling center, it's not a casino. In the end, it's kind of like an eBay, okay? Imagine eBay with companies there that show everything, but then people let emotion go way too rampant, and then boom, they start bidding on a company that's only worth $10. Now it's up to $10,000 because basically you have Elon Musk smiling at you, okay? So the point is, guys, investing is simple. It's supposed to be a very simple strategy over a long period of time, according to this book that is backed up by hundreds of years of history. So if you ask me, guys, in the end, whether you want to pick stocks and spend 5 to 8 hours every single day reading financial statements and learning about companies, that's fine if you do it correctly. Whether you want to go ahead and give someone your money to manage it and then charge you 33% of your money, well, that's not that great if you ask me. But if you want to invest into index funds and just have your money grow over a long period of time and then also have a very low cost when it comes to your entire portfolio, well, you can do that also. But the worst of the worst ways to invest is by choosing not to take any action whatsoever. Where you do stocks or real estate, whatever you want to do, at the end, the core value of this book is that investing and multiplying your money is the best strategy you can do. So whether you want to do investing like this or you want to do real estate, the entire point, you have to put your money to work. And that's why what I'm currently doing right now is that I currently invest 5% of my income into the market, into Acorns, by doing ETFs, not by trying to buy individual stocks. I don't want to spend 5 hours every single day reading. Well, I do right now 5%, but in the future, I plan on investing 25% into that, 65% into passive income streams, so for example, real estate and businesses, and then another 10% into just enjoying life. So that's my plan. That's what I want to do. But comment down below and let me know, what do you want to do? Do you want to invest into index funds, low cost, or do you want to go ahead and give someone all your money? Oh, and by the way, if you want to get this book for free, guys, I have a link down below to Audible. When you download Audible and use my entire link as a trial, you get 2 free books, including this one. And I recommend, if you want to learn how to invest on your own, I recommend you actually check out The Intelligent Investor by Graham. It's a great book, recommend it a ton. And as always, guys, if you guys enjoyed this video, like this video, really appreciate it. Helps a lot with the videos. Thank you so much. On top of that, also, subscribe to the channel, hit the bell to get notified. And if you want to talk to me one-on-one, uno, just DM me on Instagram, Tiny Bryson. And on top of that, if you want to watch another video, okay, on my entire portfolio and how it's working over the past year in Acorns, so watch this video right here. And if you want to start around, click my face right here, and I'll see you guys tomorrow. Thanks for watching, and as always, peace.